What's up, everybody? Oh man, hate all you want on Nickelback. I do have some fun listening to Nickelback. All right, so it is Thursday. It is Stocks on the Rocks. Great to be here. Small crowd, I know, Mark. Small crowd, but we'll see. It usually grows. Ah, here comes more people. Here comes more. But we're for the last minute. Nothing would ever get done, including logging into a Zoom. Here they come. There they come. I guess we'll let them in. All right. So what's up, everybody? It's Stocks on the Rocks. We do this every other Thursday night. It's open to the public. Um, and so, well, I send it out. I send a reminder out to everyone who's ever interacted with us here at Traders Army to our mailing list. And of course, I invite everybody on that mailing list to bring somebody if they want to bring somebody and give them the link and have them log in and join. And so that's always a really cool thing to meet new people and expose new people to maybe answers to questions they've never gotten before, what we do here at Traders Army. So it's always great to have these. Chuck is not going to be joining us tonight as anticipated. I'm not sure that he's going to be able to join us many nights. Um, we threw this on every Thursday night when he was not in the heat of baseball season. And then he realized as he got into baseball season with his children, with his kids, that he has baseball every Tuesday and Thursday night for like 2/3 or more of the year. So he is unfortunately never really able to make it on these. But if there's ever a question that you have specifically for Chuck or Herman, sometimes Herman will pop in on these things, one of our other instructors. For those of you who are not Traders Army regulars, then you can just shoot us an email, support@tradersarmy.com, and I will forward that on to both Chuck and Herman or whoever you want to answer your question. And so office hours is exactly what it sounds like. This is an open Q&A time for us to sit back, have a little happy hour. I don't know what you guys got going on over there, but it's 5 o'clock Pacific time for a little happy hour. And so feel free to, now I say this reluctantly, but I think we're all probably good, but I say use the chat box, ask your questions. If you want to use your microphone, if you want to share your screen, if you want to just talk candidly, then raise your hand, turn on your microphone, turn on your cameras. You're welcome to turn on your video cameras too. But I will say, please behave. We do open this up to more than just pro members or members here at Traders Army. And so we've had some instances in the past where some people will come in and they'll just act like children and not be the most appropriate when turning on their camera or their audio. So please behave, and I will let you guys turn your cameras on, turn your microphones on, and let's have a real conversation about anything related to trading and investing, or really anything. And if I don't know the answer to your question, by the way, I won't just make something up. I'll go find it out, and then we'll regroup and we'll bring that question back up next week. But I come planned with nothing to talk about. That's the thing about office hours and happy hour is I come with nothing. So this is completely driven by whatever questions, comments, concerns, challenges that you're facing that you bring to the table. If you don't bring anything to the table, I'll give you your evening back and we'll cut it short. So this can last anywhere between my 5-minute introduction, which is going to end in here in 1 minute, and an hour, right? We go as long as an hour. And normally we're here for the whole hour. So I feel like once the faucet opens and questions start coming through, then I think we'll go the whole hour. But if not, we don't have to go the whole hour, right? Call up with the first question. Do I have high hopes for the Spinal Tap sequel? Ooh, that's a good question. Now, I know what's happening. I kind of think they should probably leave well enough alone. I mean, I love that movie so much for everything that it is. I'm not sure why you'd want to potentially ruin the credibility of the brand by having a sequel, but we'll see. Um, I don't know. I would have probably left it alone and called it one and done, me personally. I think there's a lot of movies like that that are just classics. But I don't know. I mean, all the Back to the Futures are classics. I mean, think about if they tried to redo the Goonies. Like, how do you think that would go over right now? So to redo and bring Spinal Tap back, I don't know. We'll see. I'll watch it. Are there any previews out for it? Is the question, Carl. Are there any previews out for that thing yet, are there? I don't even know if they just talked about it or if they're starting to make it. I haven't seen any. I haven't looked, so for all I know, they're out there. But um, you haven't seen the original, Mark? Well, I would say we should have a Traders Army movie night where we watch Spinal Tap over Zoom. We have a movie night? How awesome would that be if we did a movie night once a month? We pick a movie, we just sit on Zoom, and they could be trading related movies. They could be The Big Short. They could be Trading Places. They could be Margin Call. A lot of different trading movies out there. And then we could throw Spinal Tap in there for you, Mark. Yeah, you got to watch Spinal Tap. Come on. Love it. But these go to 11. Add it to your list. I have the DVD here, but I'm not even sure. I probably have a DVD player somewhere in the house. But I do have the DVD here. I'll fax it to you. I'll fax it to you. I'll get right on that. All right. Great way to kick it off, Carl. I love it. All right. What else you guys got? I am not sharing my screen because there's nothing for me to share until a question is asked that is warranting me sharing my screen, because some of you guys might want to share your screen as well. All right, Tushar just made it in. Oh, we got some more people coming in. Maybe they have questions. Don't get shy on me now, everybody. Don't get shy on me now. This is all about getting you can't have no questions. Or maybe you don't. Welcome, everybody who's just logging in. So we got about 4 or 5 people that just came in from the waiting room. So slow start with the questions. So tell you we'll go about 10 more minutes and see what you guys come up with. What do you guys think of this price action in the market lately? I'll ask that question. What do you guys think of that? Get into a real conversation here about current markets, maybe. Where did my dashboard go? There we are. Mark says it's all over the place. Yeah, it's violent. It's volatile for sure. But what's interesting is any day that the market tries to sell off, we are kind of seeing some decent rallies. Now, yesterday we saw a rally that resulted in a sell-off at the end of the day. So it's still very volatile. We're seeing, what's interesting, let me go down to a 1-hour chart or even whatever, 15 minutes, something like that. Right. And I'm going to 1 second turn on extended hours. And what's really interesting is you can see an index travel. So the S&P opened up today higher. So the SPX, the SPY, they all gapped up. Great earnings response for Meta and Microsoft gapping up. So that caused the whole market to gap up. But the market opened up, S&P opened up this morning, dropped 0.25%, rallied 1%. So there's 1.25 travel. Dropped 1%. There's 2.25 travel. Rallied another little more than 0.5%. There's almost 0.75%. So there's what is that, 3% travel? And then dropped at the end of the day 1%. So there's 4% Down, up, down, up, down, only to actually move a 0.5%. That's the nature of today's market, right? Is you get so much travel. 1% up, 0.75% down, 0.75% up, 2% down. I mean, it's just volatile intraday, but close to unchanged by the end of the day. So there's a lot of movement intraday without a lot of movement from open to close. This market reminds me of a rocking chair where it could be going back and forth and 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 back and forth, but not really going anywhere, right? That's what this market reminds me of. And I think a majority of the movement is happening on the gaps at the open, not necessarily movement and, open and then run or open and then fall. So it's wild, man. It's crazy. It's probably very good. I don't do any day trading unless I'm trading like SPX 0 DTE options. I mean, that's the closest thing that I would consider day trading. So if I'm trading options that expire today on the S&P, but even then, I'm usually a seller of options, and so that gets kind of dicey as well. When you've got so much travel up and down and up and down. So that part's it's pretty violent. Especially when, like, look at this day. Open up, traveled down 1%, a little more, traveled up 1.5, back down half, back up 1, back down almost 1. And then, I mean, it was a beautiful trending day. This was a day that actually kind of moved. At least it trended. Actually, looks like it moved something like 1.63%, but it traveled like 6%. Undo, 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 undo. Mark says there was a guy on the TradeSarmy Summit in 2023. 2023. Did we do a summit in 23? That's a good question. Oh, on the TradeSarmy Summit. Oh, got it. Not our summit. TradeSarmy. I was thinking TradeSarmy because we've had Lex from TradeSarmy and the guys from TradeSarmy do a number of our summits, including the one in Anaheim in person. They were here. I don't know why. I just thought that, but a presentation on opening bell trading. I mean, there's a lot of energy around the opening bell for sure, which means there's a lot of risk, but there's a lot of reward potential. One would argue that, and I heard this growing up as a trader early on, like, don't trade the first hour. It's amateur hour. Don't trade the first hour. So why not? Well, most retail traders lose money in the first hour because there's just so much whipsaw and so much violence. I'm like, okay, well, that means that money is not just poof gone. Somebody's got to make that money. And so you're saying that if a bunch of retail novices lose it, that a bunch of professionals, make it probably. And the answer is, yeah, of course. The money's got to just transfer accounts. It doesn't just get lost. And so there probably is something. I mean, there is definitely something to the amount of energy that enters the marketplace from stocks being closed the whole night, especially around earnings season, or when there's economic reports. There's a lot of energy, and that burst of energy happens right as soon as the market opens. First hour, first half hour, very violent. So you can get whipsawed around. I usually, even on my SPX trades, when I'm trading something that's, expiring tonight or this afternoon, I usually wait about an hour into the market for that energy to kind of subside and all the hopefully the volatility calming down. because I'm usually out there selling out of the money put spreads, call spreads, iron condors, butterflies, things like that, just to kind of get out of the money. And I want all that initial violence and energy that comes in as soon as the market opens to just kind of go away and subside a bit. Get past that 10 o'clock reversal. Period of time where there can be another series, another round of economic reports coming out around 10 o'clock Eastern, so 7 o'clock Pacific. So around 7:15, 7:30, if I'm going to be trading intraday that day using SPX, zero DTE options, then I will usually start around that 7:15, 7:30, 10:15, 10:30 Eastern time, just to let that initial spike of volume kind of skid out of the way. I didn't take notes because, like you, I am not a day trader. Yeah, I mean, I don't blame you. I don't blame you. I wouldn't take notes on something that I don't do either. All right. You guys are awful quiet tonight. What else you guys got? This is open office hours. For those of you guys who showed up a little bit after my intro speech, this session is designed to be all about your questions, comments, concerns, challenges, things you want to talk about. I come planned with nothing. So,
Hey, Corey.
whatever you guys got. Greg, what's up, buddy? I recognize.
Hey, okay. Hope you're doing okay too.
Doing
Um,
awesome. Thank you.
Quick question. And I know you take this into account. When you have long stock, and you could sell cover calls against it for premium, for duration. Uh, but it doesn't protect you on the downside, and then sometimes you're given away upside potential uh, with the cover call that the stock moves higher, you get stopped out, and then you don't participate with the rally. Uh,
Right.
what I mean, what do you generally do? Is cover calls primarily your meat and potatoes type of deal, along with your stock repair strategy, or do you sometimes do something different in that case where you want to hold the stock, but you want to have you want to collect something against it? Does that
Great
make sense?
question. Yeah, it does. And there's a lot in there. So let's take do you have a stock that you want to kind of test this on that we want to talk about for a second? You have any particular stock? Like I'm thinking of maybe Delta Airlines. Uh
Or yeah, or spy or something like that too, or
yeah.
JPM, that kind of stuff.
Yeah, so the idea and so let's talk about two things here. So let's say that you for whatever reason, whether you were selling puts or you decided you wanted to just buy the shares at the market price, JP Morgan, let's say that you own JP Morgan, and let's say that you own JP Morgan at I don't know, let's say you bought it at 250. Let's go with it. Let's say you bought it at 254, right? 255. As prices entered this demand over here in the context of an uptrend, let's say you bought JP Morgan or you're short some puts and you got assigned JP Morgan at 255. Let's say that's your assignment price. Okay. Now, this could be a cheaper stock, it could be a more expensive stock. So I want to go purple, dashed line. That's where I own shares 255. Now, obviously, there was a period of time where JP Morgan went all the way down to 200. And when you look at something like a covered call says, I'm going to sell a call option against every 100 shares of stock that I own. That would be completely covered. No part of that's naked. And I'm willing and obligated now. If you sell a call option, you're obligated to sell your shares at that price, at that strike price, in the event that the stock is above that strike price. At expiration of that short call, you're going to have to deliver the shares at that price. So what I don't want to do is I don't want to, when the stock is down here at 210, I don't want to sell 230s or 240s because my cost basis is 255. If I'm obligated to sell JP Morgan at 230 because I sell a covered call there, then I'm guaranteeing a loss between me owning the shares at 255 and having to be obligated to sell the shares at 230. So let me start with saying that when I sell a covered call, I am always, always, always making sure that the call that I sell is at or above my assignment price or where I took delivery of the shares. First, does that make sense? Because I don't want to get in a situation where I have to
Yeah,
sell the shares for less than what I bought them for.
yeah,
Okay.
that makes sense.
Standard covered call protocol there for me. Now, in the event that there's not enough premium, right? So right now, if we were to go out and say JP Morgan, let's go to May 16th. I don't even know when earnings is. Oh, earnings are already passed. Okay, so we can be fine with this. So let's set up this. Um I own 100 shares, so I'll throw 100 shares down here, and 255 was my assignment price. So I'm just going to analyze what would this look like if I were to sell a May 16th 255 call, right? Now, right now, to sell the same strike that I was assigned at, I would be bringing in about $1.90, probably $2 at the mid. Let's say $2. Now, $2 is all I'm going to bring in for one share, or $200 for the whole contract. Now, first I want to know, what rate of return is that? And is that enough premium, right? And so if you take $2 a share that you're receiving in premium and you divide that by the 255 per share where you own the shares, you're getting just under 1%. You're getting about 3/4 of 1% in premium, which lowers your cost basis by $2 because you're going to collect that premium. And that's your premium to keep, whether you get called out of the shares or not. And you're collecting about 3/4 of 1% for 15 days worth of obligation. And to me, that would be fine for 15 days. I'd be fine with that, right? They might say, yeah, but I'll get more if I sell the 250s. I'll get more premium. You're right. You would. But now you're obligated to sell the stock for 250. So you're going to lose $5 on the share. Buy it for 255, sell it for 250 out of obligation, and you're going to get $3.75 to fulfill that obligation. To me, that's not break even, that's losing. So I wouldn't do that. Okay. I would always stick with 255 or higher. Okay. And that'll bring in a little less premium, but at least I know that I'm not going to be obligated to sell those shares for any less than I originally bought them for. Now, you're welcome to go out and say, well, how about if I sell the 257.50s? Yeah, I'll get less premium. Maybe you'll get $1.30 for those near the mid. And you're not making as high a return, right? On the premium itself, you're getting $1.30. And if you divide that by 255 cost basis, you're only getting 0.5%. But now what do you gain? You gain the upside potential of being able to make $2.50 in equity, selling the shares for $2.50 more than you bought them for, plus receiving $1.30. So your upside equity is important here. So if you thought the stock was going to get to 257.50, then you might sell those options. Okay. Standard covered call stuff. But as you pointed out, you will also carry all the downside risk. So there's no protection here. And I want to make this clear. I've often heard people call covered calls kind of a hedge to your long stock position. It is not that at all. It is not much of a hedge at all. Think about this. A hedge protects you on the downside. And so while if you were to sell the 255s for $1.83 or $2 near the mid, you're only hedging $2 of your downside risk. You still have $253 worth of risk if JP Morgan were to go to zero. So that's hardly a hedge. I would call that an enhancement, not a hedge at all, right? Now, what if you wanted a hedge? Well, if you wanted a hedge, what you would have to do is you would actually have to buy a put. That would hedge your risk. And so it's not uncommon for someone who wants to hedge their stock risk to go out and I'll say purchase an out of the money protective put. So let's say that you wanted to purchase a put option that says, hey, if JP Morgan drops, I'm willing to lose some, but I'm not willing to lose a lot. Let's say that you're willing to buy the 240 put, and that's going to cost you about $2.80 at the mid, roughly. Okay. Now your position looks like this, right? Without the hedge, you have infinite risk or unlimited risk. The stock goes to zero. You have all the risk of owning the shares. You buy a put at 240, and now if the stock is anywhere between below 240, you can't lose any more than $1,780 on this position, which is the difference between owning the shares at 255 and selling the shares for 240 plus whatever you pay in premium. Okay, so that defines your risk on the downside. You say, well, okay, but I'm spending 1% of my purchase price on insurance, and that's going to insure me to May 16th. That's right. And you might say, well, what if I don't want to pay for all of that? That's where selling the call, to buy the put would put you in sort of what's known as a collar position. Collar. You've got defined risk on the downside, but you've got defined reward on the upside. In this case, the collar almost completely pays for the put. It doesn't completely pay for it, but it almost completely pays for it. So if the stock is above 255, you are going to take an $80 guaranteed loss, but at least you can't lose more than $1,500 if the stock collapses. So you're using this short call premium to help pay for this long put premium, known as a collar, right? So there's those conversations. That'll help you define your risk. Now, in a perfect world,
Quick
you'll have
question.
something like this. Yes, go ahead, Greg.
Uh, I had always kind of heard a collar is basically once you collar the trade is essentially over, and you only collar it because you didn't want to take a tax impact or something, a tax hit at that time. You're kind of moving it forward in time, but uh, is that would that be a fair assessment? And then what would you do with that trade going forward? Just stay in the with the short call and the long put along with the stock.
Well, I would say it depends on which expiration you choose, number one. So this is May 16th. So we got what, 15 days until this expires? So if the outlook is, I fear the market's going to collapse and I want to mitigate risk, that's the whole purpose for buying the put. Or if the market rallies, I'd like to get out of the shares at 257.50, for instance, then selling the covered call and using that premium to buy the puts defines your risk and defines your reward. So whether or not you stay in the stock or not depends upon where the stock lands on May 16th expiration. If the stock is above 257.50, what's going to happen to your shares if you hold that option position through expiration? Well, your shares are going to get called away from you. So you're going to sell your shares for 257.50. You bought them for 255, so you're going to make $2.50 on the shares, but you're going to lose $2.80 on your puts. So that's lost. And you're going to get to keep your premium, which is $1.30. And that's if the stock is above 257.50 at expiration. Now, what if the stock is between 257.50 and 240? What happens to both of these options if the stock is not above 257.50, but it's also not below 240? What happens to both of those options, Greg? Actually,
Those
really for
go
any,
they go worthless.
both of them are worthless. You keep the premium from the calls you sold, you lose the premium on the puts that you bought, and you still own the shares. So you still own the shares. Now, what if the stock is below 240? Well, if the stock is below 240, your call options will expire worthless. You keep the premium. If you hold the puts into expiration and you let them expire in the money, what's going to happen to your shares over the weekend?
You're gonna put this. You're gonna have to. It'll take off your shares.
Right. You're going to exercise your rights automatically and you'll
Right.
sell your shares for 240. Right. Now, if you don't want to sell your shares, what do you need to do if the stock is below 240? You need to sell the puts before the market closes on the 16th. If you sell your puts for whatever they're worth, you'll keep your shares and just sell the puts, let the calls expire worthless. So, I wouldn't necessarily know that a collar is preventing you from or helping in any tax related situation, unless here's where I could see it. I had a student, it's a long time ago, but I had a student that owned shares of Apple. I mean, he bought shares a lot throughout the years, but his wife first started uh, encouraging him to buy Apple shares um, when Apple was still named Apple Computer. You guys know how long ago that was? When they were still called Apple Computer.
Sounds like the
So
80s.
it's like the 80s, exactly. 80s, 90s. So his cost basis on Apple was $7. Now, Apple at the time when I was working with him as a student was at about 150. So if he were to sell Apple shares, he would have a huge tax liability. Okay. So from that perspective, he doesn't want to sell the shares, but he doesn't want to lose money if the market drops. So he would use the put options to mitigate the risk on the downside without actually having to sell the shares, because if the stock dropped, he would just sell his puts for the profit. And if his stock rallied, he would just lose the money that he paid on the puts, and that was just his cost of insurance. I could see that being having a tax advantage, because unless Apple went from 150 down to 7, um, he's going to make less on the puts. So he's going to make money on the puts, which is going to be a taxable environment, a taxable situation. But if he makes $20 on the puts and has to pay tax on that, but doesn't have to realize his gains from 7 to 150 or 130 on the stock, he'll save money on taxes by using the puts to offset his losses without ever having to sell the shares. That might be what you're talking about, Greg. And then what you're talking about here also is the covered call helping pay for those protective puts. I can see that being uh, a tax advantage of using a collar or protective puts for sure. I had another student who owned IBM at $2 and it was trading for 192, I think, at the time. When we were talking about using options as a hedging instrument to hedge against risk, and then of course hedge against the tax ramifications of just selling the stock. But now a stock repair, just to kind of put a bow on this, and then I got your question coming here about selling puts and getting assigned, which is another question from another user here, another member. A stock repair is kind of a combination of a covered call and a bull call spread, right? So let's say that the cost basis was 255, and I didn't think that price was going to get above 255, and I wanted to lower my break even or my exit price. What I could do is I could look at, okay, I could sell the 255s, and that puts me at, I'll make money if the stock is above 255. That's where this elbow is, this little break point here in the risk profile. But a stock repair aims to lower the overall exit price. Right now, our exit price needs to be 255 because that's where we bought the shares. So what you could do here is you could say, okay, what if I sell the 250s? Now, if I just sell the 250s, then I'll still make $16 if the stock is above 250. But and now my new out is 250 because I'm collecting enough premium to offset what I would lose in the shares if I had to sell the shares for 250, even though I bought them for 255. I'm getting enough premium to offset that loss, right? But what if I did this? What if I sold 2 of the 250s? Oof. Well, now I'm naked on one of the shares. I'm naked on one of the contracts. I'm obligated to sell 200 shares, but I only have 100 shares in my possession. That's why you see the risk profile that goes into infinite risk or infinite loss, because if the stock ramps to 290 or 310 or 330, I'm obligated to sell JP Morgan at 255, 200 shares, and I only own one. Now, how do I cover my other contract? How do I cover my other contract? Well, I could buy 200 shares. I could buy another 100 shares, and then I would be completely covered. But what if I don't want to buy another 100 shares? Could I buy another call option? Now, if I go down to the 250s and I buy one call, now I have one call plus 100 shares. And the market maker and the broker don't really care how you cover your short options. If you're short two contracts and you have 100 shares and one right to buy 100 shares, they consider that covered, right? If you own two calls and you're short two calls, that's covered. If you own 200 shares and you're short two calls, that's covered. But also, if you're long 100 shares, long one call, and short two calls, that's fully covered. Is everybody clear on that, first of all? So what I have here is I now have one covered call, long 100 shares, short one call at 250, and I have a bull call spread, long one call, short a second call, which is a bull call spread. And the spread width is $2.50. Now that's not by accident. Why is that not by accident? Well, because if I were to have to sell my shares for 250, what loss would I be taking on the shares? 255 minus 250 is $2.50. So if I'm going to take a $2.50 loss on the shares, I need to be able to make up that $2.50 using the bull call spread, the one extra share, the contract that I'm buying. So now when I do that, my break even or my out price is 252.50, right? And if the stock is above 252.50, I'll get out of the shares. And now because I'm receiving a $1.91 credit to open that position, I make $191 profit, but the stock doesn't need to be above 255 anymore. It needs to be above 252.50. And that becomes my new break even. Can I get it down even further? Well, let's go check it out. If I want to go down to the 250s and say, I want my break even to be 250, that means I would take a $5 loss on the shares. So I need to have a $5 wide bull call spread to cover that loss. So if I do short two of the 250 calls and I buy one of the 245s, that's a $5 bull call spread. I'm getting a $1.20 credit. Notice how I'm still going to make $120 because that's the credit that I'm receiving. But now I make $120 if the stock is above 250. So what I'm doing here is by doing the stock repair, I'm able to lower my exit or break even price. So now the stock doesn't have to rally quite as much. Can I get it down to 247.50? Well, I don't know. Let's look. If I sell the 247.50s, now I'm going to take a $7.50 loss on the shares. So now I need to go out and say, well, I'll sell two of those and create a $7.50 wide spread. I don't think that's it. 240 needs to be it. Here we are. So that's a $7.50 wide spread. I want to open this for a credit. I don't want to have to pay for this stock repair. I want to open it up for a credit. This still gets me a 40-cent credit, it looks like. And what does that do? That lowers my profit potential to $40, best case scenario. But I make $40 if the stock is above 247.50. So now 247.50. Now the stock barely has to move between now and May 16th. And my out without loss, with actually a $40 profit, the stock just has to close above 247.50. And now I've lowered my break even price for this expiration window. For this expiration window, which is May 16th, down to 247.50. Okay. And that's a stock repair. It's a covered call plus bull call spread on the same stock at the same time. And you'll see that the bull call spread is how you profit from your long call at 240 to your short call at 247.50. Greg says, why are you choosing a bull call spread versus a bull put spread? Because you won't make the same amount of, well, you could. I mean, theoretically, you could say, I'm going to sell a covered call at 247.50, and then I'm going to sell a bull put spread at what would that be? 247.50, 240. And that would do a similar thing, but you're selling a bull, but you're using the same strikes. 247.50, 240. You're using basically the same strikes as the bull call spread. Right. So you're in the ratio spread. Same trade. But it's an easier fill. I mean, I guess I haven't tested this, but it's an easier fill if you're like, I want to sell a covered call and I want to buy a bull call spread all in one order. When you're using all calls, same strike prices, just a different ratio. In my mind, it's going to be easier to get that order filled versus selling a bull put and selling a covered call. But the combination of the two positions is still the same risk profile. It's the same. But the back ratio spread that we're calling the stock repair, the whole point of it is to bring your break even or your exit price down so that you don't have to see, like if we didn't do this, if we didn't do that, like the stock repair here, hold on. Then the stock would have to close above 255 for us to get out. This way, the stock repair gets us out at 247.50. Right? And essentially been able to lower the exit point from 255, roughly. Been able to lower the exit point by almost 3% by just doing a stock repair. So that's 3% less the stock has to rally for us to be able to get out for break even or better. That's the point of the stock repair. Now, the stock repair, I will add, does not cover downside risk. So it's not a hedge, just like a covered call is not a hedge. A covered call will lower your cost basis so you can get out at a little bit better of a price. Stock repair does the same thing. So if you wanted to hedge your downside risk, you'd still need to go out and buy puts, right? Which you would be doing with whatever capital you want to, however much you want to buy puts for, right? And you could marry puts to this whole thing. Does that make sense? Good conversation, Greg? All that makes sense? I mean, really anybody, does that make sense?
Yeah, I appreciate you using the analyzer along with it. It brings the numbers to light.
Good. Yeah, man. I will tell you, if you have not, and I know a lot of you do, because we spend a lot of time in the analyzer and the option trading rooms here. But if you want to get insanely intimate with how options strategies work, how your Greeks evolve, how P&L evolves, how risk graphs evolve, adding different positions. I mean, we're talking, this is the window that will teach you the most. This is the tab, the Analyze tab. This is the tab that will teach you the most about options and the evolution of your position over time. So spend a lot of time in this window. It'll do you some good. All right. So question, Corey, hi. When sold puts gets assigned to me, so short puts, I do the covered call above the price where it was signed to me. My problem is I have a covered call and stock. Price goes higher than the covered call strike, and I end up leaving money on the table. That's right. So there is the problem with covered calls, right? So if you own, let's use this example, JP Morgan at 255, and let's say that's where you were assigned, and let's say you sell the 257.50s, and let's say you get $1.30 near the mid for them, right? You're usually pretty happy in the moment. with, oh, I'll make $380 if the stock is above 257.50. Pretty happy at the moment with that, right? But in the event that the stock runs to 270, you're like, well, I was happy with $380 profit until the stock went to 270 and I could have made I could have made $1,500 profit. So what's the question, right? You're going to leave money on the table if you sell a covered call and you don't manage it. That's a fact, right? So the question that I have would be, if you're worried about the upside potential, then one thing to do is not sell the covered call. Just don't ever sell covered calls. If you're worried about missing out on the upside, don't sell a covered call ever, right? If you think the stock has a chance of rallying, just don't sell the covered call. Second thing that you could do is, I want to sell the covered call, which, by the way, if you own shares, you own 100 deltas worth of stock, 100 shares. As soon as you sell that 257.50 covered call, you drop your net delta position down to less than 100 because you're long 100 deltas, but you're short roughly 21 deltas, giving you a net of 79. Now, let's evolve this thing. Let's say the stock gets up to 257.50 and it's like, oh my gosh, it's at 257.50 and I'm risking having to get rid of the shares. Okay. Now, if it happens, let's say it happens 1 week into the trade, you will have at 257.50 an $18 loss if you were to close the shares and buy back the calls. You would have an $18 loss. Now, technically, if you just own the stock, you'd have a $250 profit. So why do you have a loss here? Well, because what you're making on the shares, you're losing on the short calls. So if you want to keep the shares, you need to buy back those calls. And then you're going to take a loss on those calls. That's a fact. You're going to take a loss on those calls. But what you can do is you could roll those calls up and you could roll those calls out. So you're not taking a net loss because you're still making 70 to 80 deltas, 85 deltas. You're still making money. You're just not making as much money as you could. So if you want to roll those up, you have to buy the 257.50s back for a loss. And that may cost you, let's say it costs you $1.50 to buy those back. In fact, I can tell you exactly how much it would cost to buy those back. It should cost, if it happens within a week, should cost you about, let's see, 257.50. What I'm trying to do is I'm trying to get this number right here, this P&L, down to 0. There it was. As close as you're going to get right there. So what you sold for $1.30 is going to cost you $4 to buy back. So that's your loss on the options. Now, you could always buy those back, roll them out to June, roll them up in another strike price, and keep walking your strike price up and out. But you will take a loss on those short calls. Now, that loss is not an actual total loss, because what are you going to make on your shares? You're going to make $250 on your shares. So you're basically just cutting into what you made on the shares to buy back these options for a $270 loss. So if you have them all, you're going to have a $20 loss, right? But the loss is on the calls, which you're making 85% of that loss back by owning the shares. Does that make sense? And so if you want to keep buying back the calls and roll it up, buying back the calls and roll it up, just know that you will take a loss on those short calls, but you are making it back, at least 70 to 80% of it back on the shares themselves. Okay. So that's how you would manage a covered call if you don't want to get out of the shares and you want to kind of maximize and keep rolling them up and out and up and out and up and out. The other thing that I would say is, and I say this for pretty much every trade that I get out of. So if I get stopped out of a trade and I lose money, or I get out of a covered call and I'm profitable, but I'm not as profitable as I could have been, which has happened plenty of times. Once I'm out, and I would say this is a good practice for pretty much everybody. Once I'm out, I would say whatever happens next is none of my business. It's like breaking up with a girlfriend or boyfriend, right? Whatever they do with their life after we're broken up is none of my business. And the only thing that can come from, poking around on their Instagram page after we've broken up and see that they're doing so well after breaking up with us or we broke up with them, it's only going to hurt us emotionally. But either way, we're going to be responsive emotionally. Or if they're just horrible after we broke up with them, that's going to also emotionally stimulate us, right? So by saying whatever happens after I'm out is none of my business, removes a lot of the emotions from whatever happens after. And I would also say this, and I've said this before too, and this is also true. If you sold the options at 257.50, let's just say, right? 257.50. And the price rips to 270. And you call me and you say, Corey, I left $12 on the table. I'm going to say, you're right. But let me show you the 5,000 other stocks you didn't trade today that also moved that much and you didn't make money there either. And you're going to say, oh, yeah. So it only matters because you were in this trade, right? But if I point out all of the things that you missed today, all of a sudden this one thing that you missed starts to become less significant. But I get it. You do want to try to get better at managing risk and managing reward potential. I totally get it, right? But the only way to manage reward potential out of a covered call is to sell the call, be happy if the stock doesn't trade above 57.50, or be happy if the stock went above 257.50, and just be happy getting rid of it. You could always get back in it by selling more puts, right? And if you're like, no way, like I've had people say, I want to sell covered calls because I like the premium, but I can't afford to get rid of the shares. I have too low of a cost basis. Great. Then as soon as the stock goes above your short call, buy it back, take the loss on that, roll it up and out. And by rolling it up and out and up and out and up and out, you keep pushing your willing to sell price higher and higher and higher and higher. And you are going to take a loss on the short calls if you have to buy them back for a loss, but you're making that loss up on you still own the shares and the price of the stock is going higher, right? That's just managing to roll up and out, up and out, up and out. Similar to selling puts and saying, I don't want to own the shares here. You're rolling down and out, down and out, down and out. Does that make sense? Was that helpful? Good. Oh, Greg, my adult beverage choice is almost always the same. I'm a silver tequila guy. Straight up rocks. That is it. That is it. When I was doing a lot more CrossFit, which clearly I'm not now, it's a problem. And they had the gym that I was at had like a paleo challenge or something like that. Tequila, silver tequila was pretty much the only thing you could drink an unlimited amount of that wouldn't violate your paleo diet. And I'm a tequila fan anyway, but that was just kind of a license. That's all I look at it as. I don't know if it's true or not, but it's kind of a license to say, oh, unlimited tequila sounds good. So yeah, that's usually my go-to. Sometimes it's Bacardi and Diet Coke. I went to see George Clinton in Parliament P-Funk last night at the House of Blues. That was my choice last night. That was fun. All right. What else we got? What time is it? It's almost the top of the hour. John, what's up, buddy? How you doing? It's been a little bit. I mean, we text back and forth, but I haven't seen you in here. It's good to see you. That's good. Busy is good as long as it's productive. Busy like a rocking chair, not fun. Busy moving the needle is awesome. We do both from time to time. All right, we're almost at the top of the hour. Any last questions before we end our happy hour? It's been a lot of good stuff in here, but not a lot of questions. But a lot of good stuff, I think. I'm glad that we had questions. Told you we'd fill up the hour. Our previous student from your or our? Oh, your previous student from OTA. Who am I talking to? That because it says 470762. I don't know. I don't remember a student by that name. That's your Zoom login. That's in Atlanta, right? Well, I did teach in Atlanta some. I did teach options for a while. For a while in Atlanta, I was their only options instructor. I would fly out there once a month. Same with New York City, same with San Diego. Irvine, yeah, that makes sense. For in Irvine, I live 20 minutes away from Irvine, so I did a lot of teaching in Irvine. All right, awesome. What's your name? If you don't mind. Rakesh, awesome. Yeah, we were texting earlier then, weren't we? Or I think you sent me an email earlier, one of the two. Yeah. If I have an email, I think I have an email from you that I need to answer still, but I'll get to that shortly. There it is. Awesome. Yeah, I think probably I think a lot of people here know Chuck and I from OTA when we used to teach there. So you're in good company. Awesome, Mark. Thank you. Greg, awesome. All right, you guys. Well, it is pretty much the top of the hour. It looks like the questions have slowed down to a screeching halt. And I, of course, always enjoy this time with you guys. So we do this every 2 weeks. So if you are, shameless plug, I won't take more than 2 seconds, right? But shameless plug. If you are a member or not a member, join us, right? Every other week. As a member, you get to join our 8 trading rooms every week. You have access to our entire on-demand content library to brush up on things like options and futures and crypto and your core strategy that you're using for looking at charts and analyzing price action, all of that. All that's included in a membership. Now, if you are not a member and you're interested in seeing what it would look like to become a member, I would come on to TradersArmy.com, go to what we do, go to your memberships. You can see all the on-demand trading courses here. You can see what you get with our free membership, what you get with an on-demand membership, which is just all the on-demand content. I say just, it's 50 hours of on-demand trading courses. Stocks, options, futures, crypto, trade plan, platform tutorials, checklists for downloads, all the documents that come with the courses, it's all yours, right? What this on-demand membership does not include is all access to the live trading rooms that we do. So if you want all of what you get here, plus 8 live trading and analysis sessions each week, and access to our Wealth Essentials stock and options portfolio tracker, then that is the pro membership. Now I'm going to do this. I'm going to throw a promo code into the chat box for first-time members. If you're new, Trader 60 when you sign up will get you 60% off your first month. 60% off your first month. So that'll drop that down. That'll help out a little bit, give you a chance to check it out. Yeah, hopefully that'll help. And then we've got additional discounts if you go to an annual plan, and we're coming up in the period of time where we're going to have more. Probably later in the summer, around 4th of July, we'll have some 4th of July deals and things like that. So whatever plan you're on now, you could always switch to one of those deals, things like that. Trader 60 is what I give everybody for their first time around, their first month around. Check it out. I promised you that I would play drums at your house. Is that what you said? Did I promise that? I mean, I'm happy to play drums any old place. Awesome. Let's do it. Let's play some drums. You have a drum set? No? How am I going to play drums at your house then? I'll have to play drums at my house, and then you'll just have to watch. I would play drums over Zoom, but it's noisy. Zoom is not good for, my camera is not good for drums. John, bring Euthanize to play along. That's true. Yeah, my son's band Euthanize. They haven't played in a while. I think we're in, because a lot of the guys are in other bands now. They tour. Some of the guys, like my oldest, is touring. Yeah, he's not on tour now. He just busted in the room right here and he's like, "Hey." And I'm like, "Whoa, I'm on a webinar, dude." But now he's on tour sometimes. They've got some shows coming up later in the month here, all in Southern California. He's playing with John Bonham from Led Zeppelin's grandson. That's the singer of his band, so he's touring. And Jason Bonham, John Bonham's son, is doing that tour with them, so that's going to be awesome. And then my youngest, who's still 15, he's not on tour, but he wants to go on tour. But we figured at 17 he'd be old enough, just like our oldest and responsible. So if our youngest gets more responsible and he's 17 and he's got offered a couple different tours that fell through for numerous reasons. Those would be the tours that I would have to go on him with because he's only 15. So I'd have to go with him, which is fine. I can do that. I'll be his drum tech. But yeah, those guys aren't playing and Euthanize quite as much because everybody's out doing other stuff. Which is great, but they are in the lineup potentially to do the Orange County Fair. They do that pretty much every year, so they might bring Euthanize back for the fair, which is always fun. Does the membership price include Chuck's future sessions? It includes everything. When I say everything, I mean everything. There is nothing left out with a pro membership. Everything, right? So all the on-demand trading, options deconstructed series, portfolio protection, stock repair strategy clinic. It doesn't include one-on-one mentoring. Obviously, that's extra. Every trading room, so the calendar of trading rooms. Where's the calendar? Calendar of events. Here's we are. So here's all the trading rooms, all the stocks on the rocks, everything is all included. So 4 futures trading rooms a week, 2 to 3 options trading rooms, crypto every other week, wealth essentials every other week for retirement stuff. So there's a lot, right? It's like, I mean, when you really break it down to the per day rate, if there's an average 30 days a month, at $149, divide that by the average of maybe 30 days a month, we're talking less than $5 a day. It's kind of low, but I get $149 a month is not nothing. I'm sensitive to that, but it does not include sessions in the jacuzzi. It does not. And it technically doesn't include live drums, but it will include, tell you this, first access, all accessed, first view at any new music that me and my bands release. That includes videos, that includes audio. So anytime my bands, Mercy Drive, here we are, releases new music, as we just did 2 new songs this year, you'll know about it first. And my other band, Big Dismal, whoa. Also, brand new songs this year, you'll know about those first. So it does include that. In fact, I just had a brand new lyric video. You guys know what a lyric video is? Type in Mercy Drive. There it is. The Longing. A brand new lyric video just dropped at midnight last night. So newest song. So you get access to all that stuff. But I just gave it to you for free. So there you go. Go listen. Go stream it. I get a third of 1 penny every time you stream it. And then I got to split that up between all the members of the band. So it includes all of that. Yep. All right. All right, you guys. Well, that's all I got for tonight. You'll see Herman has got the trading room tomorrow morning with you guys. For those of you who are members, if you're not a member and you want to check it out, sign up tonight. I'll make sure you have access. You'll have access instantly as soon as you sign up. Use Trader60 to get 60% off your first month. And from there, I'll see you guys in the trading rooms. Be good. And if I don't see you in the trading rooms, I'll see you in a couple of weeks in the next Stocks on the Rocks. Be good, everyone. Have a great weekend if I don't talk to you. Bye.